There's absolutely no way around it. If you want to reach financial freedom, then you need to be investing. And frankly, it's not as hard or as scary as you think. The problem though, and the reason that many people don't start investing until much later than they should, is because it's often made to be so complicated. It doesn't have to be this way though. You can still create passive income and reach financial freedom without knowing a single thing about investing. In fact, you can set your portfolio up to be completely automated and out of sight, out of mind. You wouldn't have to check it for 30 years if you didn't want to, and I'm going to show you how to do that in this video. Now, when you get to the root of it, to reach financial freedom, you need to create a stream of passive income that's going to replace the active income that you make from your 9-to-5 job. And there are many different ways you can invest to achieve this goal, but in my opinion, dividend investing is hands down the easiest way. It's literally money that you make without having to lift a finger, and I truly think it's the closest thing you can get to actually planting a money tree. At its most basic level, all you really need to do is invest in your portfolio on a regular basis, reinvest the dividends you receive, and then repeat this process until you reach financial freedom. The more you do this, the more your reinvested dividends can accumulate, which then allows for even more substantial reinvestment power, which then becomes a vicious cycle that we refer to as the dividend snowball effect, which is what's responsible for the exponential growth that will carry you all the way to financial freedom. And I know that sounds pretty basic, but that's literally all it takes. However, like with many things, people try to overcomplicate this simple process. But most people who are looking to create passive income just want to quit their job. They don't want to make investing another full-time job. So keeping things as simple as possible, like to the point where you don't even have to think about it, is what you want to do. It's like taking an Uber and then having the driver ask you which route you want to take. It's like, don't ask me. I really don't care. I just want to get to where I'm going. Now, speaking personally, I have a tendency to dive deep into the things that I'm interested in. Whether it's weightlifting, playing guitar, making YouTube videos, or investing, I like to understand why things work the way they do. And when I started investing 3.5 years ago, I had practically zero experience and had to learn the ropes essentially from scratch. But I got hooked and immediately wanted to sink my teeth deeper into this stuff. Even though I have absolutely no background in finance, I really enjoy learning how to analyze a business and read a financial statement. And in hindsight, considering how much I love this stuff now, I kind of wish I would have pursued it in my formal education when I was going to college. I think that would have been a really good thing for me. And with that in mind, I want to talk to you about today's video sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. And you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200+ different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. Anyway, as I was saying, to reach financial freedom with dividend investing, you really don't have to get deep in the weeds. If you don't care about the means and you just want the results, then investing in exchange-traded funds, or ETFs, is going to be the way to go. With these, you don't have to worry about whether you should be buying Apple or Microsoft or Coca-Cola or Home Depot, because with ETFs, you can own them all, as it's essentially just a big basket of stocks that allows you to buy the entire collection all at once. Now, there are many great ETFs out there for you to choose from, but there are two in particular that I think make things especially simple and also probably will deliver better results in the process. And those are SCHD, the Schwab US Dividend Equity ETF, and VU, the Vanguard S&P 500 ETF. SCHD specifically contains a portfolio of stocks that focuses on the the quality and sustainability of dividends, which is essential if you're hoping to use that income as a means to pay your bills every month. They actually make it a requirement that all of the companies in this ETF have to have been paying dividends for at least 10 consecutive years, and many of its holdings like Pepsi, Coca-Cola, Texas Instruments, and Verizon have been growing their dividends for way longer than that. Now, because SCHD is a dividend-focused ETF, it'll be the higher yielding between the two, and we can see that it has a really nice 3.6% yield with a red-hot double-digit 5-year growth rate on that dividend, which has been growing non-stop since the fund's inception 10 years ago. Now, moving on to VU, this ETF simply tracks the S&P 500, which when they talk about beating the market, this is what they're referring to. This is the market. Over the last 30 years, 98% of actively managed funds have failed to outperform the S&P 500, so owning it is a pretty tried and true way to invest. But interestingly enough, up until earlier this year, SCHD was actually beating the S&P, but now at this point, VU has about a 30% edge over SCHD. At any rate, I think these two are a pretty great combo that will give you the best of both worlds. You'll be able to keep pace with the market by investing in VU, and you'll also have the chance to generate more dividend income from SCHD. And based on their history, those dividends should grow pretty aggressively over the years, which is what you want. But anyway, this is what your portfolio would look like if you invested $1,000 into these two ETFs. With a 50-50 split, you'd have a starting yield about 2.6%, which is pretty respectable. And your 5-year dividend growth rate would be off the chart, sitting right there in the double digits, just above 10%. Not only that, but over the years, you would likely benefit from substantial share price appreciation from both of these two funds. Now, if you took one of these and invested it into this portfolio every single week for the next few decades, after 30 years, in 2053, you'd be bringing in nearly $50,000 per year in dividends, which off of only $100 per week is pretty insane. And I know, guys, in 30 years' time, that money is going to be worth a lot less than it is today. But despite that, still, I would so much rather have $4,000 coming in every single month without having to lift a finger. I certainly wouldn't be complaining about it. But anyway, let's kick it up a notch. Let's say that you decide to double up and invest $200 per week instead. In the same time period, you'd be bringing in just under $100,000 per year in dividends, or roughly $8,000 every single month, which is certainly a comfortable amount. But guys, this is just half the picture. So far, we've only talked about the income side of things, but how much would this portfolio be worth 30 years from now? If you assume a $200 weekly investment, you would be sitting pretty with $2.1 million in your portfolio, and even with a $100 weekly investment, you'd still have over $1 million in there. And the best part is, you wouldn't have had to lift a finger. No stock research, no worrying about what to buy, what to sell. This thing would have just grown in the background of your life as you focus on the many more important things going on. Let's say, though, hypothetically, you are kind of interested in being more hands-on with your portfolio. What would that look like? And how would you go about choosing which stocks to buy when first starting out? Well, that's what we're going through in this video here. We'll be building the perfect market-beating dividend portfolio with only 10 stocks. So click right over here to check it out, and I'll see you in the next one.